If you're self-employed, you know the struggle, right? You're making good money, but the second you try to buy a home, you just hit a wall. Well, today, we are unlocking the ultimate guide for you, the modern workforce. We're going to show you exactly how to get a mortgage, even if you don't have those traditional tax returns.
So you're out there crushing it. Maybe you're a freelancer, a business owner, a content creator building an entire brand online. Business is booming, but when it comes to buying a house, the whole process feels completely broken. You've probably been told that without a W-2, you're just out of luck. But what if I told you that's not true anymore? The heart of the problem is pretty simple. Conventional mortgages were built for a 9-to-5 world that, for many of us, just doesn't exist anymore. They look at your tax returns, they see all your smart business write-offs, and they think you don't make enough money. But there's a new wave of loans out there, and these are designed specifically to understand your real cash flow. Okay, first up, let's talk about what I call the self-employed mortgage trap. We're going to break down that frustrating cycle where doing the smart thing for your taxes can actually stop you from buying a home. But now for the good part. There is a new path to homeownership. And listen, this isn't some little niche workaround. This is a fundamental shift in lending that is changing the entire game for entrepreneurs. And the momentum here is just undeniable. We're talking a projected 300% growth in these types of loans this year alone. That is a massive signal that the financial industry is finally catching up to how people actually work and earn money today. So the hero of our story today is something called a non-qualified mortgage, or a non-QM loan. Now I know non-qualified sounds a little scary, doesn't it? But all it really means is that it doesn't fit into the super rigid box set by government-backed groups like Fannie Mae and Freddie Mac. Instead, it uses common sense underwriting for people with, unique income streams. Okay, so let's put them side by side. Conventional loans, they demand your tax returns. Non-QM loans, on the other hand, look at your bank statements. Now, yeah, you might see a slightly higher interest rate, and that's just because lenders see these as a tiny bit riskier, but in exchange, you get critical flexibility. They're also way more adaptable with your debt-to-income ratio, or DTI, because they get that your cash flow isn't some simple monthly number. But here's the absolute key. They look at your actual deposits, not just what's left after all your write-offs. And that, right there, is what unlocks the door. So let's find your perfect fit, because not all non-QM loans are created equal. We're going to break down the main types so you can see which one is the right one for your specific business. First up, we've got the most common option, and this is the big one, the bank statement loan. This is the absolute go-to choice for the modern workforce. We're talking influencers, gig workers, freelancers, you name it. And how does it work? It's actually surprisingly simple. The lender just takes 12 or maybe 24 months of your business bank statements, they figure out your average monthly deposits, and then they assume about half of that is expenses. So let's say you're averaging $20,000 a month in deposits. They'll qualify you based on an income of $10,000 a month. That's it. No tax returns needed. All right, next up. For all you real estate investors out there, there's a very specialized tool called the DSCR loan. And this is a total game changer. So check this out. With a DSCR loan, the lender doesn't look at your personal income at all. They only care about one thing, the property's cash flow. They use a simple ratio called the debt service coverage ratio, or DSCR. As long as the monthly rent from the property is enough to cover the mortgage payment, which means a DSCR of 1.0 or higher, you are likely good to go. It's a loan that qualifies the property itself, not you. And for those of you who are more established business owners working with a CPA, there's a third option, the profit and loss, or P&L loan. This path basically lets your CPA prepare a formal profit and loss statement that shows your business's true profitability. So yeah, it's a little more formal than a standard bank statement loan, but it is another powerful way to get that mortgage without having to rely on your personal tax returns. Now, while those loan types cover a ton of business owners, there is one group in particular seeing some huge new opportunities right now, content creators. For the first time, lenders are officially recognizing income from platforms like YouTube, TikTok, and Instagram, plus all your brand deals as legitimate sources for qualifying for a mortgage. Oh yeah, you heard me right. Income from YouTube AdSense, the TikTok Creator Fund, brand sponsorships, your Patreon subscriptions, even sales from your courses and merch, it all counts.
This income is usually verified through that bank statement loan we just talked about. As long as you can show those consistent deposits, it can be used to prove your income. The financial world is finally speaking your language. Okay, now before you rush off and start applying, we have to give you a critical warning. Let's talk about something called shadow debt, because honestly, it is a major hurdle that's tripping up a lot of otherwise qualified people. And I'm being serious, this is really important. According to our sources, this is quickly becoming the #1 hidden reason that solid non-QM loan applications are getting denied right at the finish line. So, what in the world is shadow debt? Well, it's pretty much any debt you have that doesn't show up on your main credit report. See, lenders are getting a lot smarter, and they're actively looking for these hidden obligations because they still affect your ability to make that mortgage payment. And we're talking about things you might not even think of as traditional debt. Those buy now, pay later services like Klarna and Affirm, loans you've taken out against crypto, peer-to-peer loans, or even a merchant cash advance for your business. Lenders will find these by analyzing your bank statements for recurring payments, so it is absolutely crucial to get ahead of it. You have to disclose everything. I mean, trying to hide these debts isn't just a bad idea that'll get your loan denied. The source is very clear that it could be considered mortgage fraud, and that can come with some serious legal consequences. Okay, I know that was a little intense, but now that you have the full picture, let's put it all together. Here is your clear, actionable 5-step game plan to successfully navigate this process and get that home. Here is your plan. 1. Get 12 to 24 months of your bank statements organized and ready to go. 2. Check your credit and aim for a score of 680 or higher to get the best terms. 3. Start saving and plan for a 10 to 20% down payment. 4. And this is the big one. Be completely upfront and disclose all of your debts, especially that shadow debt. And finally, number 5, shop around. Get pre-approved with multiple lenders so you can compare offers and find the absolute best deal for you. So we'll end with this question. Is the non-QM loan the new key to homeownership for the entrepreneurial class? You know, for a growing generation of builders, creators, and innovators, it really seems like the answer is a resounding yes. It represents a financial system that's finally adapting to the future of work.